It's tough because at some point, like, a dead clock's right twice a day. Have you ever heard that saying, right?
Yeah.
So everybody who's saying this stuff is coming is going to be right eventually, right? It doesn't have anything to do with where the Schiller PE ratio is, because that's one of many things that help determine or give us data that tells us, like.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with John.
Peace.
And Lee.
Good morning.
And we're excited to be here. Got a couple good things to talk about. We're going to start it off with a question that we've had coming up here recently that we just thought we'd jump on here and address pretty quick. So the idea of but the new rule with Roth Catch-Up Contributions, and like some people noticing, hey, I'm over 50, or I'm doing the catch-up through work, my retirement plan, and now they're saying all of a sudden my catch-up has to go into the Roth account. So Lee, kind of catch us up on why people maybe that, were caught off guard with that, and what changed.
Well, it's not everyone. I think it is tied to income. So I think if you make $150,000 or more, any catch-up provision or any catch-up contribution, which you can make beginning at age 50, the new tax law says that any catch-up contribution must go into a Roth, meaning that it's after tax. I don't know why. That was part of again, it's one of those where there was, I'm sure, negotiation. Somebody wanted it, somebody didn't.
Right.
So they met somewhere in the middle and said, okay, we're going to allow it, but it's going to be after tax. So that began last year. Yeah. Where anybody making over $150,000 doing the catch-up contribution, all catch-up contributions must go into.
I think that started
Roth
this year,
portion.
January 1st.
That's what I meant.
It was last year's
That's correct.
income that determined.
Yes.
And so the catch-up for 50 and over, is $8,000. And then there's the newer, kind of super catch-up between 60 and 63, which is $11,250.
Correct.
For 2026.
Yes.
And they say the $150,000 will be indexed for inflation, so that'll probably go up every year. A little bit, as do sometimes the catch-up contributions periodically. Are adjusted. So
it's not the end of the world.
Actually, I do like money going into Roth, forcing money going into Roth.
Yes.
I will say, going back to 20 years ago, how much we can contribute now versus then is amazing.
Yes.
I'm hearing these numbers now. We can, if you're in that sweet spot 60 to 63, I mean, now you're close to 40,000 that you could put away. Not quite, but it's amazing. It's a lot to put away. The fact that they're forcing money into Roth.
But it's something to be aware of, because if you think, okay, if you have two spouses, let's say you have, both people working, making really
not two. If you have two spouses, he means like if it's.
We believe in one spouse.
You have one spouse, but two together.
Biblical marriage is but no, so if you have both spouses working and making a good income, and all of a sudden, and maybe they're maxing out full catch up, they're in that 60 to 63 window. That's $22,500 of income that you maybe thought was going to be deferred, and now it's not.
And it could be a
taxable
taxable
And if you're in a 40% bracket, I mean, that's a $8,000 tax swing. So it's something to be aware of, because you might get to the end of the year and be like, man, I just feel like I owe more than I was expecting. So, again, doesn't affect everybody. Definitely can have a meaningful effect, for those that are impacted. So it's something to be aware of, and just not be caught off guard when we, get to the
end of the year.
And I have not researched this, but I don't know if some of these tax laws, they sunset. I don't know if this is one that is.
Some of them did, some of them didn't.
I don't know about this particular one.
Right. That'll be interesting to see if this is here for an indefinite period
3 years.
Right.
Okay. So that was something that we'd kind of been hearing over the last couple of weeks, and wanted to touch base on it. Something else that we've been getting asked a lot about is just the market and kind of where we're at. So we had a little bit of a pullback, kind of a stair step down. The market did not panic react to this war in Iran, right? We did not see a sharp, quick sell off. It was kind of a stair step down of like, hey, it was, we pulled back 10 or so %.
Yep.
So it was felt for sure.
And it took 11 days to come back.
But then we came ripping back. Yeah. very quickly. And so now we're right here, at or near all-time highs on all the major indexes. And so, you're quickly back to this story. It's crazy how quickly things can change, right? Because, not too long ago, like a month or two, we're talking about like, hey, is the market kind of finding a bottom? Is it going to continue selling off? But I think the question was not, it was just very different than where we're at today. Market comes ripping back, and all of a sudden we're at all-time highs, and everybody's like kind of skittish again of like, hey, are things too frothy and kind of bubbly? And you're starting to hear that stuff again. So
we went from oversold to overbought in one trading week.
Yeah.
I mean, it's lightning fast.
And one of the ratios, one of the things you'll hear often quoted is the Schiller or CAPE ratio, right? And so, John, in 10 words or less, no, I'm kidding.
No chance.
Explain to us what the Schiller CAPE ratio kind of is and what it's used for, and then we'll get into kind of the good and the bad of what that ratio.
Just in general terms, like the PE ratio in general terms is the price to earnings, price divided by earnings that determines, like, so you take a stock, you take the earnings of that stock divided by price divided by earnings, which way that goes, and you come up with a number, right? And historically on the S&P 500, we have been around 16. So going back the entire history of the S&P 500, so forget all the other, just S&P 500 has been about 16 historical average. That does not mean that if you're over 16, you're way out of whack or whatever. It just means the average stock is 16. So when we get right now, this is the second highest Schiller PE ratio in 155 years of looking at the market, right? So this is cause for concern for a lot of people that use the old, in my opinion, like the PE ratio is kind of one of those things that I grew up learning about when I was, long time ago, Matt, before you were even here.
Yeah.
And that was a big thing that we used as determining a stock's, if it was overvalued, undervalued, whatever, how was it compared to the S&P's historical average. So when I hear that it's at the second highest level it's been in 155 years, there is, when people hear that, and we get a lot of questions from clients that might hear that from whatever source or whatever, and the question is, how does this market keep going up? And why is it continuing to go up? And when is this big day that it's going to all fall apart, right? And I'll even go back to like when you have the Iran war that starts, and then you start hearing, if you're watching people that kind of think it's going to start at any time now, that's the straw that is going to break the back, right? That's going to be the thing that does it. And the market goes down 9%, almost 10% in a quick amount of time, or like you said, over a month. But that's, and you think, oh, well, this is the beginning of the end. We're going to get that back in line. And then all of a sudden this market shoots right back up. And
the market wants to go up.
Well, market wants to go up. And we didn't have the oil crisis has not been solved. The Strait of Hormuz, we had one ship made it down through there. They're celebrating that today. Like one ship made it through safely and all that stuff, and we're celebrating that today. Well, we're not through all this at all, and the markets have fought back. Okay, I go back to 2008 and I go back to 2000, and all I can say is I remember different time frames where this conversation was talked about, and I remember 2000 especially, the tech bubble burst, right? Prior to the tech bubble burst, all I heard, and I was brand new in the market, brand new in the industry, and all I heard was that it's a new market. We shouldn't worry about old history. It means nothing. Tech stocks are now going to take over the world. PE ratios are going to go up because it's about future earnings and so on, and so don't worry about any of that stuff. And then we had a massive 80% sell-off in the tech market in 2000 to 2002. 2007, similar story. The banks really aren't in trouble. We're going to fight through this. Don't worry about things being out of whack. And then eventually we had the massive sell-off 08 through 09. I don't know that this market is like either one of those markets, right? It's hard to say. It doesn't seem like it. It seems like we keep pushing forward. But it is eerily similar, in my opinion, because there's a lot of this euphoria of, okay, we have this little setback of Iran, but we bounce right back, no big deal. The market's resilient. It's going to fight through all that. When you read stuff like the second highest PE ratio in history of the market, it does cause me a
It
little
can be
concern.
unsettling when you that was 11 words. So you almost did it.
Yeah,
Okay,
sorry.
I'm glad you said that.
11 paragraphs.
Pages. So I'm kidding. Hey, in the last 100 years, we've had 3 periods where we've had an extended period of market undervaluation. We typically do not live in a world where there's equal valuation or a fair valuation. It's either over or under.
Yeah, the average is the average of the extremes. It's not
Right.
that the line that history follows the average
That's
line.
correct. So
Exactly,
if we've had 3 periods, so the Great Depression, the period between 73 and 80, where
Yep.
you had
Stagflation.
stagflation,
Yeah, yeah.
oil
Yep.
the oil embargo,
Yep.
and then the lost decade, 90 through, 2000 through nearly 2010. If those are the 3 periods of undervaluation, most of us, including most of our clients, have only experienced a lot of overvaluation periods.
Yeah.
There are some people that would say, you know what, it's always going to be this way. Yes, I get the cause for concern, but for a big part of our career, we have worked in a period of over valuations, and then we'll have the momentary sell-offs that'll bring us back to fair valuation for a period of 45 minutes.
Yeah.
and then we're back off to the races. So I guess I take the other side where I'm like, yes, it's something to think about.
Yeah.
But is our market almost made to live kind of in that overvalued world?
Well, I think so. Going back to the Schiller Cape ratio specifically, historically that they say that predicted the .com bubble, right? You could have used that to see that coming and know that the timing part on that is always questionable.
Yeah.
But
it was 2 years late, but yeah.
The issue that a lot of people, and maybe myself even have with the Schiller Cape ratio, is that you're using the last 10 years of average earnings, right? So you're taking price over the last 10 years of average earnings adjusted for inflation. Earnings for and I can make a good and bad argument here for in terms of like healthy market. The good thing about the hard part with using the Schiller ratio now is earnings for the biggest companies in the world today are so different than they were 10 years ago.
Yeah.
So you're still using 10 years earnings, historically,
right.
calculating the Schiller PE ratio when the earnings today are so drastically different, right? So before I give you 11 more words, I'm afraid I won't
12.
get the mic back. That drastically changes what that ratio calculation comes to.
Sure.
When you're
100%.
using that, right? If you use, the last, and I haven't ran these numbers, but it would be interesting to see if you use the last 5 years average earnings.
Sure.
And calculated the kind of, the Schiller same ratio, but not using the full 10-year historical earnings. These companies have more pricing power than they've ever had. Their profit margins are better than they've ever been. They're bigger than they've ever been. So in terms of control and power, pricing power, like these companies are just, they're incredible.
Yeah.
Now, there's parts of that I don't like,
Right.
because they are so big and powerful and they do make up such a large part of the market. So I think there are certain aspects of that aren't just purely positive. But I think it makes it very difficult to throw a very simple calculation, price over average
absolutely.
10-year earnings, and get one ratio and say, hey, this is where the market should or shouldn't be. I think when you're comparing, it's not that it's not relevant, but trying to compare that to history and make a relevant, informed decision off of it, I think, is tough.
It's tough because at some point, like a dead clock's right twice a day. Have you ever heard that saying, right?
Yeah.
So everybody who's saying this stuff is coming is going to be right eventually, right? It doesn't have anything to do with where the Schiller PE ratio is, because that's one of many things that help determine or give us data that tells us like that. And I would say that you're dead right. You're right on this idea that these stocks today, one way you can get a PE ratio back in line, there's 2 ways. The price has to come down to match earnings, right? Or the earnings have to go up to match price. So what we've been doing is it feels like we have been earnings have been chasing the price for a long time. So take a stock like NVIDIA that's just blown up in the last 10 years. And as the stock has risen, the PE ratio is staying, almost the same ratio as you go up. Does that make sense? Mm-hmm. Like the price continues to skyrocket, but so does the earnings. So the spread is not. That would scare me if the earnings stayed low and the price continued to skyrocket. That would show me an unhealthy, over-exaggeration.
So if you look
system.
at the average ratio,
you
look at the average PE ratio, the Schiller ratio, not PE ratio, the Schiller CAPE ratio, over the history of the market, it's like 17, 18, right? If you look at it since 1980, it's 24. If you look at it since 1990, it's like 25 to 30. So, just looking at of how the markets have changed, how the world has changed, how these companies have changed, looking at 1990 to today, that's 36 years, right? It's not a short period of time. It's the average CAPE ratio is almost double what the entire market history CAPE ratio is. And so, again, that's not to say it's irrelevant. It's not to say it's not something to be aware of and look at. But I think saying, hey, the average Shiller ratio is 17.7, the whole history of the market, we're currently at almost 40, and using that to stoke fear in people, that's easy to do.
Yeah.
Right?
100%.
And there's so much context that's left out of that I think you have to just take a step back, see what's really going on here and seeing, okay, where's the market at? Does it make sense? And what is this Shiller ratio, telling me relative to what it was telling us in the 50s and 60s and what's changed? And I would say almost everything.
Yeah. Another question we get a lot, and it's showing the undervaluation of, like, say, European stocks versus U.S. market, and is it better looking to go out there to Europe and get stocks, right? But that has been this way for 10 plus years.
They're cheap for a reason.
For 10 plus years. And they still have not. Last year was the first year we saw a little bit of
international markets,
some momentum, and then we have this oil embargo thing that it hurts the rest of the world. So then you have that momentum kind of stall, but it doesn't mean anything. Like if it was perfect science, then the European markets would have outperformed the last 10 years.
Yeah,
the U.S. markets, but that's not even close to the case.
My takeaway is I think it can be good for all of us to have reminders that making money, investing is not easy. Access to it and all that, we've talked about this on previous podcasts, has never been easier, but staying invested, understanding, educating yourself on historical markets, what markets do, what to expect, all of that is not easy. And staying the course, and making the right decisions, even when it's really hard to do that over a long period of time, is why, a lot of people underperform the market historically because they let their emotions get in the way.
Sure.
And so,
hey, 4.5 years out of my 26 years of doing this, we're negative. We're bad. To your point, going back to your original point of how many negatives we've had versus positives, even though they're bad when they're bad, that's less than 80% or less than 20% of the time in my time of being in it have we had. So when you go through these downtimes, it's just part of the, market movement. But for the most part, to your point, like, know what your risk is, know what your need is.
And I think it's good.
It.
I think it's also good to have humility. The market as a whole is not dumb, right?
Correct.
So to sit here, and this is where I think you can get in your own way. It's easy to sit here. I say it's easy. I think human nature makes it where we want to sit here and think like we have this gut feeling, right?
Sure.
If the market is wanting to go higher, it's going to continue to want to go higher until it doesn't. Correct. And I know that may sound no crap, right? But to sit here, and if you're sitting in your office and you're like, I've got this feeling, you're not smarter than the collective market.
100%, yeah.
Right? And so as long as the market is wanting to grind and go higher, until something throws it off course, you don't know more than the collective market. And I say that, and you might be like, well, thanks, Matt. I know that. But I think it's a good reminder because we've all sat there and just had that feeling of like, oh, I know something. Even if you can't define what that is, you just have a feeling. And it's like, don't listen to that, because that is
the markets will humble you.
Yeah, but think about this freight train that's the market, and it's driven through the COVID storm. We had a 3-month downturn and COVID. That's it. That was a worldwide pandemic that caused unbelievable changes in everything that we do.
Yeah.
In everything we do. And we had a 3-month downturn due to COVID. We then had the interest rate hike, massive interest rate hike of 2022, which, yes, caused
22 was
a
tough.
downturn.
I mean, 22 was a
Yeah, it was a down
not
year.
a fun year in the market. You know,
And it was really a 6-month period in 2022 where we lost the majority of what we lost for the year.
Yeah.
And so you have that. That was pretty dramatic to the market, and the market somehow gets through that. Inflation never gets really because all the inflation that was there, yes, the inflation number goes down, but the inflation prices are still there. Right? The economy still moves forward. The train eventually gets through that, muddled through that. Then you have how many things have happened since then, including this Iranian, this most recent thing. And the market continues to the train just keeps going.
Climb
And
the wall of worry.
until it, and like you said, until it doesn't. And anybody who thinks they know exactly when that is, you should have your own private island and shouldn't be talking to anybody anyway.
Yep.
Because you're really rich, is what I'm trying to say.
Okay, last thing we were going to talk about. You're going to have to remind me because I forgot.
Today marks the
the
beginning
Fed.
of the
Fed.
final meeting of
Jerome Powell. Nothing against him personally. I hope I never say his name again because
Exactly.
I feel like he's the only person I've talked about for however many years.
You
he's
know,
been
there
in
was there was some thought that he would be around in June. Because Senator Tillis was threatening to hold it up.
Yep.
But the Justice Department dropped their lawsuit, so it looks like he's going to be on a path to.
I wonder what the
confirmation here in next-
emotions for someone like a guy like that who's been through what he's been through and that just dealing with the
Powell.
yeah.
Oh, he's looking
Like,
forward
what
to.
does this feel like?
He's getting ready to join the speaker circuit, and he's going to make a lot of money. And
Yeah, he's going to ride off into the sunset.
Yeah.
But
I mean,
I
yeah.
think
Honestly, with all the negativity around him, I personally think he did a great job in landing the plane from the high interest rates to the low interest rates without creating an entire mess. I really do.
The only criticism I have, and it's not really of him, it's the entire Fed. Going back however many years you want to go back, the power the Fed has is out of control, in my opinion, and it goes back to 08. And I think they made massive mistakes in 08, 09. And it's easy to look back and say that.
Yeah.
But I do think they did. And they didn't correct them, and they didn't have to correct them until Powell made those interest rate hikes in 2022, which he had to do. I totally get it. So it's not on Powell. The problems to me are
it started years ago.
just in general terms. And I hope the new Fed somehow can come in and fix some of those things. And you have to get really into the weeds
Sure you do.
to know what is right, wrong, what needs to be fixed. And it's opinion more. I mean,
So it'll
we'll
be
see.
interesting to see what the comments coming out of this meeting.
How history will judge him.
Well, I'll be curious what he says about inflation, like the concerns of inflation in the higher oil. And I almost feels like he's going to stick it like it. I just wonder what's going to happen.
I don't think he will. I
No,
think
he probably won't.
It'll be a rather mundane meeting.
I think
I don't think
ready to-
anybody's
yeah.
expecting a rate cut.
Me and
No,
John,
no.
me and you are going to hear Janet Yellen this summer.
Yeah.
Oh, yeah.
We're
Yeah.
going to go to a conference in D.C., and so we'll hear Yellen speak. So maybe we'll get to ask her opinion on Jerome Powell. See, how do you
Right.
think Jerome Powell did?
Yeah.
That's awesome.
Anything else? Any parting words or thoughts?
No.
So I think my takeaway from today's conversation is just, there is so easy to pull a headline, whether it's, hey, historically second highest Schiller PE ratio in history, and immediately feel anxiety or fear.
The noise is loud.
I would just recommend take a step back,
Yeah.
take a deep breath, do a little bit of research. It doesn't mean that it's meaningless, but it also doesn't mean that it is meaningful and will help you, tell you what's about to happen.
And as we've seen many times, we are in a headline news driven society to where it's that's a great headline. But like you said, take a step back, take a pause, take a deep breath.
And just know, I'll also say, last thing I'll say, know your situation. Know what affects, like what would happen to you if you're fully invested in the market and you're 60 and you're going to retire in 2 years and the market's at all-time highs and we've gone from 6,400 on the Dow to 50,000 on the Dow in your last 16 years of work, and you've done incredible and you're a millionaire. That is when you reevaluate, should I be pulling back? Not because the market's going to collapse, or we can't time that, but just because it's the smart thing to do.
Prudent planning.
Right, prudent planning. Just do prudent planning.
Yeah. All right. Well, as always, we appreciate you guys watching and listening. Shoot us a comment, give us a like, subscribe, shoot us an email if you have any questions. We love the questions that we get and getting to address those each and every week. So we look forward to seeing you guys next week. I hope you have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.